Perfect. All right. Good morning, everyone. All right, let's get this started. Can we, Pamela, you're muted and
Let him promote the other trustees before you
I
start.
was gonna say do it because I don't see everybody here.
Yeah, they're in the other room. So.
They're actually not in the other room either.
Yes,
no.
we have Jeff Hawkins in the other room. He's a participant. Jeff Hawkins.
Well, I'm right here.
Oh, no, there you are. Sorry, I'm looking at the wrong list. Oh, okay. I just can't see everyone, so I thought they were on. My bad. Go ahead, Evelyn. Your meeting.
All right. Oh, we have Sebastian. Good morning. We have David coming in.
Yes, if we can just remind everyone that this meeting is being recorded.
And is John Heiler joining?
Yes, I had a quorum this morning.
All right. Good morning, David. Good morning, Samara.
Let me text him. And if we may remind everyone, the public comment section, which is located via the chat feature at the bottom, please sign up via the chat feature. Just include your name and the words public comment. We will open your mic at the time, and each participant is allowed 2 minutes to speak.
Okay, I'm gonna wait 1 more minute and then I'm gonna get started.
He's just having technical difficulties, Evelyn. He is trying to sign in.
Okay. All right. All right, we have a quorum. We're gonna get started.
Okay.
Because by the time you do roll call and we approve the minutes, he may be in. All right, so let's go. Can we get a roll call, Pamela?
Of course. Good morning, everyone. For the sake of efficiencies, I'm only going to say your last names on all of the votes. Arano Ortiz.
Present.
Arenas.
Present.
Heiler. Joining. Hawkins.
Present.
And Mr. Leonard.
Here.
Wonderful. We have a quorum.
All right, perfect. Okay, so the first item on the agenda is the approval of the minutes for January the 5th. So can I please get a motion?
Moved.
Any updates, any edits, any comments? Silence, I'm gonna take it as a no. Can I get second?
Second.
All in favor, roll call?
Arano Ortiz.
Yes.
Arenas.
Yes.
Heiler. Hawkins.
Yes.
Leonard.
Aye.
All right, motion
You're
passes. There we go. All right, Mr. Sebastian, long time no see.
Good morning, everyone.
Take it away for us.
Absolutely. Well, it's great seeing you. It's been quite a bit of time since I've got a chance to see you all face to face, at least virtually. And we have, I think, some very good news for you today when we look at the portfolio review. And as we do at this meeting every year, one of the things that we always want to do is just to reaffirm and reassess the asset allocation of the portfolio and make any recommendations in terms of rebalancing, which we've provided as well. So I know that the time is a little bit limited, so we've provided a little bit of a cut down book here that I'll be reviewing with you initially, but you also have, I believe, the full deck as well. So happy to review any of that information. But where I thought I'd start is to give you a quick summary of performance on page 2 of this material. And page 2 is just an executive summary of where we are as of January. February, if we had the results, which we'll have here probably in this week, they'll be positive as well. So I think to start the year, we're really just seeing a continuation of what we saw last year, which was extremely strong performance 2020. And it's kind of funny because if we were sitting here at the beginning of last year, the things that we would have been talking about is that we're in an extended cycle. It's a little bit long in the tooth, but still has some room to grow. We do expect some volatility to be on the horizon, and we want to make sure the asset allocation reflects that. Little did we know that within a month or two, we'd be in the middle of a global pandemic and the world would be shut down and everything would be turned on its head. But fast forward a year, at least from a market's perspective, if you're looking at the return of the portfolio, as of the end of January, the 1-year return on the endowment is nearly 18%. It's a strong, strong, strong result. And we'll talk about what's driven that in just a moment. But as you look over to the right, you can see the long-term performance of the fund out to 10 years, up 8.6%. We do compare ourselves here to a 60-40. No institutional endowment is typically invested just in 60-40, but from a risk perspective, it does provide a nice comparison for us. So you can see that on a net of fees basis, we've outperformed the broad-based market benchmark by over 200 basis points. Strong results throughout. We'll touch on the allocation in a moment. When we look at assets today, so at the end of January, the endowment's assets are north of $73 million. So again, if we're looking at gains and investment earnings over this time, strong results there. And we don't have the quarterly rankings here. It's in the larger book, but as of the end of Q4 2020, over all periods, the library ranks in the top quartile of peers, meaning that you're beating over 75% of peers in your universe. So very, very good news throughout. If we turn to the next page, this is a little bit more of a detail around performance for the portfolio. So January was a bit of a, I don't want to call it an anomaly, but when you start hearing things like Reddit and GameStop and some other weird terminology around people who are trading on the interwebs, driving markets, it's not a typical situation that we see. And the second half of the month was driven by that. A lot of trades and companies that typically are not thought of as higher quality, typically have negative sentiment associated with them. They were driven by retail investors who pushed that part of the market, and it really created a little bit of a headwind for many institutional managers who invest based on higher quality fundamentals, governance, et cetera. That being said, the portfolio returned a flat return for the month. So it held up extremely well in a fairly volatile environment. But as you scan up and down the line, and I'll focus you more on the 1-year column here than the 1-month column, you can see that all of your managers have done very well in this portfolio. So whether it's Diamond Hill, whether it's Earnest up 18%, UBS up 34%, Impacts, and that's not a typo since inception, they are up 77% for you. So the timing and entrance of that investment was more than opportune. The minute we got into that, the strategy just has been sort of experiencing very, very good returns. And then the same thing when we look at the fixed income allocation, clearly yields saw pressure over the last year, and the performance there has done extremely well as well. So overall, good results. So no changes in terms of the manager lineups, no concerns with any of the managers in your portfolio. I will give you an update on one of the managers, that's Siegel, Bryant, and Hamill. This is an equity manager who does a little bit of fixed income as well, based in Chicago. They recently announced that they will be selling themselves to a corporation out of Canada. Currently, their ownership structure is a combination of a private equity firm and internal ownership. We've been seeing this move a lot recently, where you have smaller firms looking for strategic long-term partners, where perhaps they solidify their ownership into the future, but they still have autonomy on the structure and the investments, et cetera, which is the case here. So not much of a concern, but at the very least, we wanted to make you aware of it at the moment. And other than that, when we look up and down the list here of managers, nothing else of note to report on. So I'll stop there for a second to see if there are any questions around anything around the portfolio.
No, I would say the investment committee is brilliant for the choices that they made. It's sometimes better to be lucky than just be good. I think the timing of some of the choices and some of the allocations that we made, of course, these are really wonderful numbers. And I guess that's not to take away from all the good news. That's always has me overly worried when we see this kind of market move so quickly and happen so fast. A lot of the stimulus money coming in around the world, especially in the US. What is your firm's outlook right now toward this kind of all the boats seem to be floating nicely, and what do you guys see on the horizon, and are we allocated in the proper way to deal with kind of this huge valuation in the markets right now?
A little bit of deja vu,
Yeah,
if I could say.
yeah.
And it seems to be deja vu over and over again as to what's driving markets. But I think that's a perfect segue into page 4, because this is really the meat and potatoes of what we want to talk to you about, which is asset allocation. So as you all know, at the beginning of each year, our asset allocation team sits down and we look at what we're seeing in the marketplace in terms of themes that may be driving investment portfolios in the markets on a go-forward basis. And I joke a little bit in that part of these themes is deja vu, because we've been here before, post GFC, throughout the 2010s, and the support that the central banks around the globe have provided. But the one factor today that really we don't have much control over is the virus trajectory. And we think that this is one of the main themes that will drive the market, and really, depending on region and economy, will have a wide range of outcomes. And the reason I say that is, as we sit here today, and just focusing on the US, we have a pretty strong vaccine rollout. We're having good acceptance of the vaccine. We're starting to see the economy open up state by state, region by region. And the expectation is by the summer, we'll have a good amount of the population, vaccinated. And there's this pent-up demand in the US where people have not been able to go out to restaurants. People have not been able to travel. People have been sitting at home. And this is more of a general comment. People have been sitting at home. And if you actually look at the last year, the savings rates of individuals has increased significantly. So there's pent-up demand, there's cash to spend, and there is a demand to spend it. So there's this view that, especially in the second half of this year and into next year, we'll see a big bump in growth. And on top of that, the stimulus package that was passed as well supports that. However, you look at Europe, and it's a huge contrast to what we're seeing in the US. They are seeing their second or third wave of increased infections. They're seeing issues with some of the vaccination rollout, and they're actually taking a step back, and we're seeing some closures in their economy. So there you have a little bit of a dispersion as to what we're seeing here. So it's not an equal footing depending on where you are. That being said, overall, we think that we will see some positive growth over the coming year on the whole. And we think that given where rates are, even with the increases recently, that does support a little bit more in terms of risk assets. The reason we say that is because of this theme of permanent interventions, which is the second theme listed on this page. Really what this means is that the Fed has, and central banks around the globe have basically said that they will do everything they can to support the markets. And from a Fed's perspective, that means, at least on the shorter end of the curve, rates will remain lower for longer. They will stimulate the economy as needed. And if you're an investor, such as the library, you have to think about it from an asset allocation perspective. And if fixed income is giving you 0 to very low rates, you have to earn your portfolio return somewhere within the market. And that builds an equity risk premium or risk premium to other assets. And we think that given this support that we're seeing, that even at current valuations, we're actually comfortable with a slightly higher allocation to equities than perhaps we have in target. So we'll touch on that in a moment. The last two themes here are globalization backlash and China transitions. these two themes have been ones that we've seen on this page for quite some time because they're long dated themes, right? If you kind of think about, back 5 or so years, the globalization backlash theme was sort of this view that people were looking more inward around the globe. You saw more extreme on the far right, on the far left, potentially getting into power, which didn't necessarily come through in a lot of areas. But you saw these extremes sort of making their way into the mainstream. And the view that really the efforts of the last 50 years, this globalization that we've been seeing, we're cracking. We're actually moving more inward, focused on individual countries versus sort of this global approach. This has evolved a little bit, and it's more of an equality condition that we're seeing today, sort of the haves and have-nots, if you will. And really, I joke about the whole Reddit situation, but that sort of plays into this theme, right? It was the average investor up against the institutional investor, and showing that, we can do this as well. That provides a little bit of variability because it adds unknown to the market. We think that over the long term, this is something that will continue to play out, and the outcome there is one yet to be seen. And then the China transitions theme really is just one where, as investors, we can't ignore the rise of China, just from a global player perspective. So if we think about how China's evolved over the last decade, they've moved away from this manufacturing type economy to a service-oriented economy. They've grown their economy significantly, and the likelihood that they overtake the US as the largest economy in the next decade, 15 years or so, is there. And really, this is just in recognizance of that, that as investors, we'll have to contend with having two very massive global powers, and how we want to play that investment theme is one that will be playing out over the next number of years. So I think
Yes, Sebastian, on that, but for a macro view, because I do think that's maybe one of those things that could really disrupt the global economy, depending on how far, Biden or the U.S. and China doesn't deal with the trade agreements and doesn't deal with, following or listening to each other, and that could be a problem on the horizon. Do you see anybody at all? And I guess why I'm asking this, I don't know if it's going to be a problem. You see the EU cut a business deal with China right after they pretty much take over Hong Kong, and they're doing the things that they're doing. You see the press come out and they talk about Myanmar, yet China's never in the press. So is there really going to be an issue there? Or they just, it's all about capitalism and forget about human rights? Or do you see corporations and pensions eventually saying, hey, because it's not going to be from governments, it sounds like, standing up to the Chinese, it's going to be more from, but have you guys seen any of your clients, any of the pensions, any of the endowments say, hey, we want to stay away from China? Has that even been any type of conversation or yet?
it's
Sebastian, hold on, Sebastian, for a second.
Yes.
Pamela, can you please note that John Heiler has joined the meeting? Thank you. All right, Sebastian, keep going.
Absolutely. So I'll rewind us a couple of years back. So if you're looking at this 3 or 4 years ago, there was this huge push for China A share, direct China exposure. The market was opening up. You didn't have to invest in H shares, which are the Hong Kong shares. You can invest directly in the local market. And there was this huge boom around this because you had this vast, unexplored, uninvested institutional market at your fingertips. Fast forward to today and what's been going on in China for the last, call it 6 months to a year, where there's been relative peace between sort of the state-owned companies and the companies that have driven a lot of the growth, the Alibabas, the Tencents of the world. You're seeing the Chinese government encroach on those a bit, and the whole fallout with Ant recently. And actually, if you were reading the journal yesterday, I think China had wanted Alibaba to divest from their financial positions or financial services positions, as they want to really have greater control over that, as I believe they see that as a risk. What you're seeing, I think, is a pause and a refresh as to how institutional investors want to invest in China today. But you're right. I think from a corporate perspective, there were also articles the other day about Vanguard reassessing how they want to be involved in China, specifically to the announcement around Alibaba, because that's how they were going into the marketplace there as a partnership. So long-winded way of saying it's being reassessed. I don't think it's being abandoned. I think
So I guess that's where I'm coming from. this isn't an issue for me on human rights, and it's going to take institutions like ourselves to say, okay, there's no freedom of the press, censorship, wiping out any type of democratic individual liberties and rights. And I guess, for me, and I get it's a very difficult thing for an endowment our size. I'm just hoping some of the bigger players begin to evolve on this human rights, the abuses, and how we just can accept the things that they're doing to humans. And I didn't know if there was any type of movement yet. And it sounds like some people are discussing it, but it really hasn't had any legs yet. And it looks like capitalism wins out.
It does, but I think, John, I think one of the things that you're seeing though is as you see more prevalence of ESG being incorporated into portfolios in a more outward way, I think you'll see that evolve as well, because that does put pressure on, for as large as China is and for as powerful as the government is, you also rely on capital coming in to help support the growth that they're seeing. And if you see pushback from large multinational investors, I think that does put pressure on you at the very least to assess some kind of a change. But I think that's still sort of in front of us. But I think I shouldn't say little by little, because I think it is gaining steam overall. You will see more and more of that.
Great, thank you. Sorry to take so much time.
Sebastian, would you, in parallel to that, would you mind commenting on the vulnerability in the emerging markets right now? I don't see that as a particular key market theme that you've called out here. And also give a little more character, if you would, to the impacts holding and the social investment strategy that the trustees implemented several months ago, because I think that's a parallel to John's question as well. Sure, and vulnerability in what way? In terms of recovery post-COVID, vis-a-vis the size of our holdings in that space. Absolutely. So when you think about, let's just take a step back and talk about the universe that's emerging markets, right? If you look at the emerging markets index today, it's predominantly China. About 42% or so of that index is China oriented. And then the rest of it is really the BRICS, if you will. So Russia, India, and Brazil. China has, at least at the high level, done a great job in the last year in maintaining growth. They attacked the virus early on. They were able to, at the very least with what they were discussing outwardly, contain it to a large extent. And they weren't as impacted as some others were within the global economy. So China actually posted positive growth last year, unlike the rest of the world, which had either negative or significantly negative growth. So I think the region actually was quite resilient in terms of everything that occurred. And it's one that did quite well last year. And we've seen that sort of continue because of the fact that these economies kept moving along during the period. And we think that on a go-forward basis, because of that, they're still positioned well to provide growth for institutional investors. That's a more broad statement. If you look at the individual countries themselves, each one's going to be slightly different. They make up a slightly different part of the universe. UBS, who is your emerging markets equity manager, is a highly concentrated bottom-up stock picker. So they're not necessarily worried about the domicile of the country they're investing in. They're more worried about the quality of the company they're investing in. So from their perspective, they don't necessarily need to have exposure in every single market and every single sector and every single industry. They just want to have the best companies they feel are poised for growth. And that's what they've done in their portfolio. So I think as we look at it today, we actually have a favorable view of emerging markets simply because they've not been as impacted. They've actually been very resilient throughout the last year. And I think just regionally, if we're looking at the global equity space, and we look at it from a perspective of the MSCI ACWI. So the MSCI ACWI is sort of the global S&P 500, if you will. And if you look at the regional exposures within that, today, roughly 57% of that benchmark is the US, roughly 13, 14 is EM, and the rest is non-US developed, so Europe and Japan. When we're thinking about asset allocation and exposures, we actually prefer that investors are overweight EM in the US and underweight Europe and Japan, simply because we don't see the growth prospects there. And for a lot of the issues that we spoke about early on with the on and off closures, et cetera, restrictions, we think that that's a headwind towards growth as well. So it's not to say that we don't think there are good companies there. We don't think there are some opportunities there. We just think strategically an underweight position makes sense today. And then in terms of
impacts, right?
Impacts, so impacts is a strategy. If you remember last year, we did a lot of work around what the underlying exposures were of the fund, whether that was energy related, whether that were some other sectors. And we made some moves in order to really reduce the fossil fuel footprint of the strategy, improve outward ESG and sustainability type exposure. And that culminated in the hiring of Impacts. So Impacts really they invest along long-term macro themes around things like growing populations, around rising living standards, rising consumption, depletion of fossil fuels. So they're really focusing on where they see the future economy moving and moving away from things like fossil fuels, moving away from things that might not have great environmental, social, or governance factors to them. So they take a thematic approach. This is a smaller cap global equity strategy, so it focuses more on the end user to drive a lot of that performance. And that's exactly what they've done. They've invested in more sustainable projects, things like water infrastructure, things like resource recovery, environmental support services. These are more tech-focused areas, and they move you away from some of these areas that have been in the press and that we actually just didn't want to have exposure to in the portfolio. That's something that really has driven the return story for them last year. If you recall, especially on the energy side, energy prices collapsed last March at the beginning of April. So there was a ton of pressure on that industry. Not having exposure and really betting against that in the case of Impacts, that's where a lot of that tailwind came in terms of their performance. Then obviously they are bottom-up stock selectors. So a lot of the stocks that they've invested in have hit in terms of where they want to focus their allocation.
Sebastian, then if you look at their the breakdown of their was more due to their exposure to tech, and therefore then really their exposure on the impact side, or was it a combination of those two things?
You cut out there for a second. I heard the tech part. I didn't hear the first part.
Oh, sorry about that. Well, let me turn my video off. Maybe that works better. Was their performance really tech driven then, or was it impact driven? In other words, were they riding more of the tech wave from last year?
It's going to be a combination of both. So because they're invested, or they're some of the themes play in on sort of clean tech, green tech, if you will. That area of the market has seen a little bit of a boon. Then, as we all know, tech last year, any tech related stocks also experienced quite a bit of an uptick in 2020. So it's going to be a combination of both in this instance, but because of where they're thematically positioned, you're really experiencing sort of the best of both worlds, if you will, I think, in this strategy.
Yeah. Hey,
how does that compare to the? Sorry, John, just to follow up on that.
No, go ahead, Sanjay.
If you take a look at the underlying equity exposure that we have and just try and put it on the very simplistic, growth versus value or tech versus non-tech exposure, how do you think our equity is balanced or not balanced right now, and how much did we outperform last year because we had more of a growth tilt versus a value tilt?
So, if you look at your portfolio, you have two. In the large 20% of your U.S. equity portfolio, so between Diamond Hill and Siegel Bryant, has a value tilt to it. So structurally and strategically, we've invested with managers who have an outward value tilt. Earnest is a GARP manager, so core with a little bit of growth tilt to it. UBS also, although they'll tell you they take valuation into their stock selection decisions, they profile a little bit more growthy. And then obviously Impacts is a growth portfolio. So I'd say you actually have a pretty good balance on within your equity portfolio, being split fairly down the middle in terms of the growth value trade. So we've been pretty balanced there, and I think that's really worked in our favor. Clearly, if we had to assign attribution to performance for 2020, it does lend itself to the growth exposures, particularly in Impacts, particularly in Earnest and UBS, as those significantly outperformed their benchmark. I think what you're seeing this year, though, is there's a little bit of a rotation towards value. So having that value exposure, especially early on, has been quite beneficial as well. And I think you're going to see more of that when we look at the February performance, because we are seeing a bit of a rotation here towards sort of, again, I know we don't have much energy exposure, but your more cyclical names, financials, et cetera, have been outperforming thus far.
Yeah. Hey, last question for me. The inflation and the stimulus money, I know we just touched it briefly a few minutes ago, but I mean, what's the firm's outlook longer term, and how quickly do you see that becoming problematic toward the markets and the bond market as well? And do you see rates kind of starting to finally move, which we've seen over the last few weeks? But do you see this as long term or more beginning to affect us on the shorter horizon? And how are we positioned that way?
Shorter is sort of the answer. So when we look at all the statistics, we're seeing a little bit of inflation pressures early on, and they're coupled with deflationary pressures early on. So some of the early comments I made around the potential growth that we might see this year, and then demand, that pushes up inflation, right? There's demand push inflation because, again, there's just this pent up demand for goods, services that haven't been there, and that'll drive up the cost of goods and services. You've seen financial inflation, which has been driven by a lot of the stimulus packages, et cetera, and the expansion on the underlying asset prices. But there's also the other side of this, which is deflationary pressures. So the fact that we're meeting over Zoom today, that eats into travel budgets, that eats into a lot of what you would see in a normal course of business. So AI technology is actually a deflationary force in this instance. A little bit of the demographic trends that we're seeing long term in the US, that's a deflationary pressure. So we're seeing a little bit of both sides of it. So when we think about asset allocation in that instance, we do think that the market's pricing in, if you're looking at break-even inflation over the near term, a slightly elevated level of inflation, but over the long term, it normalizes back down to that 2% level, maybe slightly higher. And that's our view as well, is that in the short term, we can see some inflationary pressures, but over the long term, that normalizes. So we're not expecting a spike, but that's the one thing with inflation, is sometimes you don't know it's there until it's there, and you want to make sure that you're positioned in a way that you're protected against it. In the portfolio today, there are two areas that have a direct correlation to protecting against inflation. One is the TIPS position that we put on a little while back. So you have about 8% in dedicated TIPS in the portfolio today. The second is actually the PIMCO All Asset. The PIMCO All Asset strategy, among other things, is a highly diversified strategy, but its goal is to beat inflation by 5% over time. So it's actually an inflation hedging type strategy. So we have about 20% of the portfolio that's outwardly dedicated to benefit if we do see a rise in inflation. In terms of fixed income, clearly a rise in inflation deteriorates your current value. So rising rates are one way to combat that. If we were to see a situation where inflation came back roaring and the Fed had to move quicker than what they've been communicating currently and raising rates on the shorter end of the curve, that clearly impacts any type of growth that we were expecting to see in a negative way, at least in the near term until things normalize. So, this kind of goes back to the comments of there's a lot of different outcomes with everything that we're seeing today, but long-winded way of saying in the near term, we are seeing a little bit of pressures, just simply everything building up that we've talked about, but over the long term, we do see that normalizing. So we take a more long-term view. So when we think about asset allocation, which is actually on page 5 of the deck.
Oh, I was gonna say, because we have like a few contracts, I mean, this is great discussion. But I was gonna say, does it make sense to go and look at, because I see in page 15, Sebastian, that you're recommending
Mhm.
some shifts.
So maybe we can go right to that, Evelyn.
Can we go to that?
Yep.
I mean, although, you know, everybody else, is that okay? Or do you want to review this piece first?
So that's fine. with
Doing
me.
the asset allocation discussion in preview mode, so.
Okay. Yeah.
Well, exactly right. All these comments lead to the asset allocation discussion.
Yeah. All right. So we can move through it.
Yep. So we can probably go to page 7 of this deck then, which is basically the culmination of what we were talking about. So our expectation for inflation over the next decade, which is what our assumptions are based on, is about 2%. Over the long term, it normalizes to about 2.3%. So it's something we review consistently, and we think that that long-term view makes sense because there will be different regimes within there. But in thinking about the asset allocation, really what we wanted to focus on is 2 things. One, let's streamline the asset allocation, make sure that we have the correct targets in the portfolio based on what we're seeing for opportunities today, and simplify it in that we think the current asset allocation is generally where we want to be. I think it's positioned us to a good long-term exposure, but within that, we just want to make some minor shifts. So if you're looking across from left to right, we've profiled your current allocation as of the end of January, the current target allocation, and then a mix A here on the far right. For the moment, I'd not look at the current target. I'd actually focus your eyes and compare the current allocation to mix A, as that's what we're using as sort of the basis for the target. So given my comments around where yields are today, that we do believe that they still will be low for the foreseeable future, barring anything happening in the near term. We think that having a slightly higher weighting to equities as a long-term investor makes sense. There's a risk premium associated with those. And as a result, we actually want to bring the target allocation closer in line with the current allocation and increase the target to equities to the 60% level. Within that bucket, what we're doing is we're trying to balance the regional exposure, as I mentioned earlier, around where we think there is opportunity. So a slight overweight to US relative to an MSCI equity benchmark, slight underweight non-US relative to the MSCI equity benchmark, and then a slight overweight to EM. We also model out your global equity exposure around the same types of targets. So looking at the entirety of this allocation, that gets us to about 60% US equity, 15% emerging equity, and 25% non-US equity on a look-through basis. Within fixed income, really just balancing safe haven assets and yield-seeking assets. So John, to your question earlier, do we have exposure to inflation-sensitive assets? We do. We want to maintain that. But at the same time, because we have pressures from both sides, we want to be able to sort of balance out that sensitivity and keep a very highly liquid and safe asset in the portfolio. So you're seeing here a recommendation to add treasuries at a 7% level to basically complement the TIPS allocation. So the combination of these two really acts as a very safe liquid asset that historically, if we've run some analysis, has done extremely well, especially if we do see more volatile periods. We want to complement that with the core bonds and multi-sector. And I know sometimes the question comes up with core bonds, aren't they a safe haven asset? And to an extent they are, but they're not a pure treasury allocation, especially with someone like an IRNM. You will have corporate exposure in there, you will have credit exposure, you will have some yield exposure. So it's not necessarily a pure play. So we think the combination of TIPS and treasuries, core bonds and multi-sector makes sense. And then the final piece here is around global asset allocation, where you have PIMCO today. We had initially raised this target to about 20%. We never went down the path of filling it. So we think today it doesn't make sense to look for that additional manager. We think that within the strategic allocation, we can achieve what it is that we wanted out of that initial target move. So we're recommending about an 8% allocation today to GAA. What that does for us is that it gives us a portfolio return of about 5%. It reduces the vol number here to about 12% and maintains sort of the efficiency of the portfolio. So we're doing a number of things. We're repositioning the portfolio to take advantage of today's opportunities. On the fixed income side, we're balancing more safe haven assets with yield-seeking assets. And then we're really just focusing on the strategic parts of the allocation. So it seems like potentially a lot of moves, but it's actually just minor rebalancing within the current portfolio construct of the library.
Can we go to can we show that? That's because that's on that other slide.
So page 8 is actually where you see the moves. We thought, why not just show you everything on one page? Make your eyes cross a little bit.
I like that.
So you can see really what that entails in terms of the moves. As I mentioned, the only new addition here would be a treasuries allocation, which we can achieve with SSGA. It's a couple of basis points, so highly inexpensive, highly liquid, passive exposure, provides nice balance here within the portfolio. And to get to the new targets, it does require a little bit of rebalancing from the portfolio. So really you can look at it, especially from the US equity perspective, as harvesting some of the gains that we've seen over the last 12 months or so.
Okay.
Yeah.
So I think we need to take, do we have a vote on the record?
No,
So
we
it
don't
would,
vote on this.
yes, Evelyn, we would need to vote on the asset allocation change and then the rebalancing, which I could work with Sean and the team to help implement.
So basically, Sebastian, we're just reallocating, taking some gains off the table from the last run up and putting it off to the side, kind of.
Exactly. So what you're seeing here is actually a reallocation from equities. We're increasing fixed income slightly. And again, that's that liquid safe haven exposure. And we're moving away from where we are at 37% today in US equity. We're harvesting some of those gains, adding that to global equity, to impacts, et cetera, to really diversify that approach.
So Pamela, for us to rebalance, I think we need to take a vote, and that's not on the agenda.
Yes, I just saw that. I didn't know that. I'm sorry.
No, that's okay. So can we call for a vote for the reallocation? All right, so the vote is to accept the reallocations as, presented on, what was the slide number? I think it was 7.
Page 7, yep.
Which is the BPL mix A, and then the movement of the dollars as documented in this mix A implementation page. So can I get a motion, please?
So moved.
Second?
Okay.
All right, roll call, Emma?
Arana Ortiz,
Yes.
Aranas,
Yes.
Tyler,
Yes.
Hawkins,
Yes.
and Leonard. David?
David?
Yes.
You got it. Thank you. Got it. The motion was passed. Thank you.
Motion passed. So I just want to call out, and that was not, it was a kind of a short meeting, but I just want to say something on the full deck. And I think, Pamela, that's available to the public. I just want to call out that in the full deck, there is some quarterly updates with their new partners and the newest principals. And I'm happy to see, my friends of people of color included in your partners and your principals. So, thank you for always keeping up abreast of the happenings and anything. Anything else for Sebastian? Sebastian, this was loaded today.
Yeah.
Thank you. I always appreciate it, especially when you have good news for us.
I do have a quick question. Are we taking this to the trustee meeting as well? Like, is there?
As an update, yes.
Yes,
Yeah.
okay.
Yes. That will be an urgent as an update. All right. I'm going to close this out because we have a few contracts. Thank you, Sebastian.
Really
Thank
good
you, everyone.
presentation,
Thank you again.
Sebastian. Nice job.
Thank you, appreciate it.
All right. All right, next on the agenda, we got contracts. Oh, wait, I got the wrong one. Here we go. Thank you. So let's start with, what do we have? E-rate first?
Yes.
And then we have a couple of items for E-rate. So because they're all related, we're gonna take those as a lot instead of as a one piece, okay? So Ellen, Kurt, you guys wanna talk us through E-rates?
Sure. Good morning, everyone. Just as by way of background to those who are new to the E-rate votes, E-rate is a federally funded program where if we are awarded the money, we will pay either 10 or 20% and the feds will pick up 80 or 90%. So it's always a very good value for us. The first vote is for the internet service connectivity backup between Copley branches and the emergency hub. And the second is for, I believe, switches. And I'm sure Kurt can answer any questions on this far better than I can.
So these are the two items that are over $50,000. There's a total of 6 items that we're hoping to get E-rate funding for. It's going to be part of upgrading our switches. A secondary item that's not seen here is also upgrading the UPS or the backups for the switches throughout the BPL. And then the first item in this list is the connectivity between all of our locations. And there's 2 separate items that are about providing internet access to the BPL, as well as our DR site and a high-speed connection between our data center and the DR site. So these specific votes are around the higher dollar value items. And one of them is for the connections between all of our locations. That's the multi-site connectivity services. And then the second item is for the network hardware upgrade, which is all of the switches throughout the BPL. It's expected that the funding for these items will be around 85%. So the cost to the BPL alone is going to be around $157,000 for the switches and around $30,000 a year for the multi-site connectivity.
And the benefit of implementing these is improving reliability and bandwidth, I'm guessing, right, Kurt?
So the multi-site connectivity is an existing service that we pay for every year. We were up on our 3-year contract, so we bid this out again, and the City of Boston's Do-It department came in with the lowest price. They're also the vendor we used in the past, and we've had a great service with them. Other bidders came in higher, and there was also some questions about whether they'd be able to deliver the infrastructure timely. And then for the switch upgrade, those the existing switches are 5 years or older at this point, so we're just looking to upgrade to the latest model for switches to improve the service.
Right, any questions in regards to those items? No? All right, can I get a motion?
Moved.
Second,
Second.
roll call?
Rana Ortiz,
Yes.
Arenas,
Yes.
Tyler,
Yes.
Hawkins,
Yes.
Leonard. David,
Yeah, Luce,
Yes.
mute
Can you
button.
not hear me?
there he is. Yes.
Yes,
we
now
can.
we can.
Okay, the motions have passed both votes.
Okay,
Could I just add one other thing?
sure.
The with the passing of the American Rescue Plan, there's $7.1 billion allocated towards E-rate with specific purpose of extending the E-rate program beyond the our locations. So for things like hotspots, Chromebooks, etc. So being able to get funding, it's actually going to be at 100% rate. A lot of the details haven't been worked out yet, but we are expecting some of our existing services and potentially additional services that we're going to be providing to also be covered by E-rate in the near future for the services provided during the COVID.
Oh, that's really good news.
Yeah.
Yeah, thank you.
Yeah.
All right. Services for security, Ellen.
Morning again. This is the 3-year security bid. Currently, we have G4S. G4S did not submit a bid this time. We had 5 companies bid the contract. Our evaluation team found that Securitas was the best bid. They were not the low bid, but we have not gone with the low bid before. Similar to G4S, they are a union shop. They are also SEIU, so there shouldn't be any changes to compensation. The benefit package was really quite good. And I have Emily Tkazik on the phone too, as she was on the evaluation team, so she can help with additional questions.
Yeah, Emily, can you, one of the things about these contracts is DNI, diversion and, diverse and inclusivity. Did we have some language around that?
Just give a moment for her to join the panel.
Getting formatted, okay. And while she joins, I know that these bids are a quality bid. We don't, like you said, we don't take the lowest bid.
Right.
Can we get a little bit of a background?
So the reason we haven't taken the lowest bid in the past, certainly the last time, is because they brought the contract in lower because they were paying low wages. And it is not something we want to do, or the city wants to do, or in the past the trustees have wanted to do, is to lower the cost of the contract by cutting the employees' wages. We don't think it's fair, and we also don't think it's good business practice for us, because we have long-term employees who know our buildings and we don't want to lose them. I would say that we do put in the contract that we ask them to speak to quality and efforts towards diversity and inclusion. And we do intend to put something into the contract where they have to report that to us. We do believe they have a diverse management team here in Massachusetts, not Massachusetts, excuse me, in the United States. We do look for diverse vendors when we go out to bid on anything. There's Emily now. When we go out to bid on anything, and we did not find a company that, a diverse company that could bid this contract. We also advertised the contract in the Boston Globe, in the City Register, and in the Commonwealth's Goods and Services Bulletin. So people that are looking for government contracts typically know to go to those places to look for what is out to bid. And as I said, I think we got interest from 7 companies and ended up with 5 bids.
Ellen, you said that the previous vendor did not apply for, could you?
An oversight on their part. We had told them during our conversations in the fall, as you might remember, we had increased our use of G4S, both because the Boston Public Health Commission needed security at 2 COVID locations. And we were providing, once we reopened, we were providing G4S services at all the branches. We did have conversations with them and told them we would be bidding it in the late winter, early spring. They did not follow up. We did not reach out to them, but it is their responsibility as a vendor to know what's going on with the contract. They did say to me last week that their salespeople should have reached out. So unfortunate that they didn't have an opportunity to bid it. They have been a good partner to us, but we do feel good about the Securitas contract.
Good morning. Sorry for the hold up there.
That's all right.
But as Ellen had mentioned, within the RFP, there are certain criteria that are included for how the committee is going to grade the different proposals that come in. And one of the criteria that was included for this RFP were for quality and efforts on diversity and inclusion practices. So the Securitas proposal certainly had a lot of language talking about their continued commitment to hire and retain a diverse workforce. They talked about continuing a goal to increase diversity representation across the company as a whole nationwide. And they also showed a strong commitment toward female employment and actually gave figures of how many females are employed across the company. Within the proposal too, they showed us resumes of the management that's going to be overseeing the library contract. And within those resumes, we were able to see that it was a diverse group, diverse team of managers. And also within the resumes that they'd actually been promoted throughout their tenure with Securitas as well. And the other piece that we had spoken about as a committee, there's one role that still has to be filled. Obviously, if they're awarded the contract, there has to be an on-site supervisor. So we were going to continue the conversation with them just to make sure that they understood we really wanted to encourage a diverse workforce as they're hiring that person.
I appreciate it. Any further questions regarding this contract? No? All right, so can I get a motion?
Evelyn, if I may, because
Yes.
the vote does not include the dollar figure, I think probably we should read it into the record. So unless you object, I'll do that now.
Yeah, and actually, is this vote approved contract for one? Oh, so it's a 1-year contract with options to renew. And
Yes.
right, and I was going to say, is this a recommendation for full approval to the board, or this is for us to approve?
So no, we delegated this because of
We
the
delegated,
timing. So we did ask for a delegated vote for both this and E-rate.
Yes.
So year one is $1,536,963.96. Year two is $1,592,747.52. Year three, $1,650,168, for a total potential 3-year total of $4,779,879.48.
Okay.
Just a quick question, but we're voting to approve just year one at this point, with the option of
We do have you vote for it for the 3 years, but any renewal would be subject to appropriate funding by the city. That hasn't been an issue in the past, but we do need to leave it open.
okay, thank you.
All right. Thank you for calling that out. I didn't realize the money was not there. All right, any more questions around this? No? All right, so can I get a motion to approve?
So moved.
Second?
Second,
All right, roll call, Pamela?
Okay, Evelyn,
Yes?
Zamawa,
yes.
John,
Yes.
Jeff,
Yes.
and David.
Yes, yes, yes.
Motion was approved. Thank you.
All right, thank you. All right, Kurt. Technology plan.
All right. So I will try to keep this as brief as possible. I think that you've all been given the full draft of the technology plan to read more of the details, but I also sent Jay a slide deck that we could go through to briefly visit each of the goals and initiatives associated, and I'm happy to answer any questions. But I think the end result of this is to get additional feedback from all of you and a decision on whether or not to bring it before the full board. All right, let's dive right in, Jay. So I saw this as an opportunity for me to kind of level set with the organization as a whole and with the public as what I see as being primary areas for us to focus on and priorities for us to focus on with improving technology throughout the library. And we'll dig into some more of these goals specifically, but focus on impact and outcomes, extending the library's reach, expanding educational opportunities, developing spaces that meet evolving patron needs, enabling one library, driving organizational efficiency, and improving IT fundamentals. So at this point, the technology plan has been shared with all of leadership, and it's been a way for us to kind of get alignment on what all of these goals and initiatives are, get feedback. And in many of these cases, as you can imagine, these these goals do require a heavy amount of cross collaboration. So interacting with other departments is going to be key to success of these goals and initiatives. So Jay, if you could move to the next slide. So I also took this opportunity to kind of reframe how to view the IT department. I think sometimes the IT department can be seen as a place to go and get equipment or to get assistance with something. And I really wanted this plan to kind of bring forward that the IT department is here as a strategic business partner, and that when any other departments are thinking about bringing new services forward where there might be the ability to include technology to make it more efficient or make it more impactful for our patrons, that that's something that we could be a part of upfront early on, and then help with the delivery of that service. So helping people to become more innovative and become more efficient in the services that we provide. So moving on to the goals and initiatives, as I mentioned, this is really going to be a cross-collaborative process. So this document serves to get alignment from other departments and to also inform people about what's important to the IT department and technology within the library. And if you look at the detailed technology plan, you'll notice that with each initiative, there's also details about what activities are involved within that initiative, and also what other departments are going to be key to the success of that initiative, estimated costs, and if there's some key roles that are also important to be filled to assist in that initiative being successful. So now I'll just go through each of these in a little bit more detail to give you a little bit more color. So focus on impact and outcomes. This is really about us level setting about what the library sees as our key performance indicators, and then bringing that data forward for all of our staff to be able to easily understand where we're at in meeting those KPIs with different services we provide, and that we could also look at, if we want to provide a new service, how are we expecting it's going to move the needle on certain KPIs that we continually measure against. So this is something where we see an opportunity for us to improve in how we're doing, and it'll be important in rolling out additional services. So Jay, if you could just go to the next slide. So with each of the initiatives under each goal, I've got here a Harvey ball that kind of indicates how much benefit is this going to have for patrons and staff, and also how much staff effort involved, and a rough idea on cost. Currently, the initiatives don't include the cost of staff and are really about the additional things that we would have to purchase to support that, that initiative. So as I mentioned, with this focus on impact and outcomes, we're going to want to just really take some time and effort to define better what are our key performance indicators. And we already have a lot in place with our reach numbers, but looking to kind of further refine that. And then along with that, how do we make it so that that information is more available? So putting in an appropriate data analytics platform, which is going to require setting up a data warehouse and having an analytics platform connect to that to get real-time or close to real-time data for staff to regularly view. And then, that last point is, the quality of this running reports is only going to be able to really be trusted if we can trust the data. So how do we improve the way that we collect data today and make sure that the reports that we're running can be trusted? So one example of what this could be is improving the people counters throughout our system for more accurate tracking, and so that we can see better metrics on this event occurred, so we saw this increase in visitors, or things like that, where we can make better business decisions at a more granular level than we are able to today. I'm happy if anybody would like to ask any questions throughout, but I'll otherwise just.
Oh, I was writing them down so I could ask.
Save them for later. Okay. All right, we can.
I didn't want you to lose your rrhythm. So,
all right. Well, thanks.
So write them, because I'm keeping track of my questions. So.
All right, great. So this next one's about extending the library's reach. This is really about, how do we get our services to patrons who might not have access to those services today, and how do we or access to the equipment that allows them to access our services today. And and then how do we also reach more people that we're not, maybe aren't a target market today, that we're not fully considering. So Jay, if you just move on to the next slide. So these initiatives, as you can imagine, would be increasing technology access. So we're thinking about, how do we provide more external Wi-Fi, which some of these initiatives we're already in process of, and others are less developed. So, but with the external Wi-Fi, we've actually expanded that at 14 locations since summer last year. We have our existing hotspot program, but we are planning to expand the lending and pairing it with Chromebooks to be able to allow our patrons that maybe don't have internet connectivity or a device at home to be able to borrow a Chromebook with a hotspot for a short period of time. 1 week is the current plan. We also have expanding advanced technology lending. So I see an opportunity for us to kind of reach those more advanced technology users by providing additional types of lending services, such as maybe advanced photography equipment, or maybe a GoPro type thing, but sort of encourage more of that shared economy type lending, where the things that you use for a shorter period of time that can create a lot of creativity within patrons, and innovation is something that we can help foster more of. And then the last one is enabling online financial transactions. And this one's one that we just, a little bit behind on and need to execute on, so that patrons, especially as we're returning to service in our building, that we're not requiring a in-person transaction to occur, and that patrons will be able to pay for their fees and whatnot online, or fines. Right. Expanding educational opportunities. So this one's actually twofold. So I see that we already have a lot of education programming throughout the library today. I could see us expanding this in a few different ways to better reach our patrons, but one of them is around providing more tech assistance opportunity. And with some existing roles, there's the ability for that staff to provide additional assistance online. And so I just see a way for us to kind of have greater impact, reach people in their own homes through more online assistance for technology. I also see us having this floating programming kit. So currently, if we have sort of a new exciting type of technology that we want to roll out with programming, we tend to focus around the innovation spaces throughout the system. And one thing that I would like for us to do is, instead of focusing around those branches, we instead create these kind of traveling kits that could be sent to different locations, and then we can do a better job at meeting patrons where they're at and not having to force them to go to a different location for more advanced technology programming. And then this last one is about technical training and support within staff, because I think really the greatest impact that I think that we can have for our patrons is by improving the technical proficiency of all of our staff, especially the public facing staff, so that there's not a specific place that they need to go if they need some assistance with their phone or their device, and that that can just be done by raising the bar on what we expect of staff with technical proficiency level. Develop spaces that meet evolving patron needs. So I think, you know, there's a lot of change that's happened with COVID. And I think, you know, as I mentioned, we expanded our external Wi-Fi, but our spaces that we focused on were spaces where there was room for people to gather and or maybe have a place to sit down and work with that Wi-Fi. But it really needs to be taken more to the next level, since these spaces aren't as accommodating as they could be for people to work outdoors. So I would like that to also be a focus of ours. And then meanwhile, looking at, you know, as we return service, how do we keep up with the demand? And as we all know, with COVID and video conferencing becoming more and more heavily used, people who maybe didn't have a need for video conferencing in the past, it's going to be more important in the future. So looking at all of our spaces and determining improvements to make them readily available for someone to do a video conferencing session. And then the last item on here is just with improving digital signage. And this is twofold in that we haven't, within our Johnson building, when you enter, there's the existing digital signage that exists there, which draws a lot of interest and has some really interesting features. But I think that we could be doing a better job at directing patrons to where they need to go and allowing them to do a little bit more self-service, exploratory, to figure out what they want to do at the library that day, and have better wayfinding to get to where they need to go. But this is broader than that, in that we also want to look at digital signage in other locations that incorporate wayfinding, as well as events and you know, highlighting events, and potentially highlighting other services or even online events that we'd like to let our patrons know about. Enabling one live.
Kurt, if I may just let you know that we need to wrap you up in a few minutes to allow for questions and the vote.
Okay, great. I'll speed it up a little. So enabling one library. Let's just go to the next slide, Jay. You know, here we've been doing a lot of effort to improve the way that staff communicate, especially since we've closed down by implementing collaboration platforms. But we really need to keep going and moving on that and improving the way that we manage our documentation. We also want to look at improving the process for tracking key relationships to make sure that if somebody in one branch talks to a program provider or service provider, that you know, the people in the other branch who might be considering that person also are aware of past communications. And we have sort of this, you know, when you come and work with the BPL as a partner, that it's a unified experience, that everybody at the BPL is aware of the last communication that was held with that provider or partner, or maybe even vendor that we want to track within this. And then the last one is refining the integrated web experience. So making it easier for patrons to visit our website and figure out where they need to go, regardless of the department behind that area. So if somebody's looking for a specific print, that they can really easily be able to find the digitized content of that on Digital Commonwealth, et cetera, but creating a more unified experience there. So driving organizational efficiency. This is just looking for ways that we can improve how we operate today. And part of that in trying to leverage technology to improve how we run throughout. So timesheet procedures, integrating IT better with employee transitions, and the booking of spaces. And this last one is much more of what you'd normally expect within a technology plan, but for an IT department, if you just jump in there, we're going to look at revising our business continuity plan, establishing a regular refresh schedule where staff can expect when they're going to be upgraded next, well in advance, improving our existing data center infrastructure, which we're in progress on, increasing our information security measures, and also continuing to improve professional development for all of the IT staff. So to kind of wrap this up, it is expected, coming from a Scrum background, I expect that we don't create a plan and then it sits there and we do exactly what it says, but that it evolves over time. So in that sense, I want to be transparent about what the goals and initiatives are, and hosting all of those along with the activities around it and updates on it within a platform that any staff can access, and with the expectation that while the goals and objectives will probably stay the same, the activities surrounding them will change, and this is a place where people can easily go to get an update. All right.
So Kurt, this is really good. I want to say, love the mission. You know, it includes benefits to not only the staff, but also the patrons. I think you're focused on the right stuff. The KPIs, when do you think you will have them defined?
So I think I mentioned that there's certain roles that we're looking to hire as a part of this. And one of those is a data analyst. And we have a lot more of technical capability within the IT department, but we don't have someone who's dedicated on more of that business focus on data. So I think that there's activities that we should do without waiting for this role to be filled, but that the continual follow-up is going to require that person's effort to refine.
All right, so let me reframe the question. So are the KPIs more in terms of measuring IT in general, or is it applying, KPIs to the different initiatives or goals? So for example, like I'll pick on extend the library's reach, increase technology access. So I would define the KPI of, increasing technology access by X%. Is that what you're looking to do? Is it KPIs in regards to the department?
I see it as KPIs as being KPIs for the organization, not for technology.
Got it.
And as a part of that, it could be, are we providing the services that patrons need? How many hotspots did we lend last year? But what's the real impact that's creating? And it can be a little bit more challenging to discover, but are we improving the neighborhoods in which maybe a lot of lending is occurring, because we're allowing these patrons to be able to position themselves better for jobs, et cetera, or they're able to access online services better. So I think that's just something that we as a whole need to explore more, and that technology is going to support.
Got it. Okay, I see what you're saying. So you have a lot of work ahead of you.
Can I ask a question too? And Kurt, thank you for this overview. It's really comprehensive, and I like the mission and the articulation of the goals. One thing that sort of stands out for me is the digital equity and the digital divide and technology's role in that. And it seems implicit in your plan, but I feel like there's an opportunity to be more explicit about how the plan can help us address the digital inequities that we're seeing in the city and that have been worsened by the pandemic. So just reflecting on that as we also think about KPIs and increasing the library's reach, what does that mean from an equity perspective, and how does the plan center equity? I think I'd be really interested in that. Can't hear you, David.
It looks like.
Can you hear me now?
Yes.
I seem to be having a delayed microphone issue this morning. So I think when we share the strategic roadmap, which we plan to do at the full board meeting next week, you'll see the more higher level service-oriented goals, which include the digital equity more explicitly as a service-oriented element. What I believe that we are trying to ultimately deliver is a combination of plans, and the technology plan is one part of that ultimately moves our whole mission forward. So certainly an equity approach in general and specific to the digital divide is certainly something that is front and center in the overall roadmap.
Great, thanks, David.
One of the things that that I want to call out, one of the things that I don't know if you guys follow the Boston Globe they have like an ongoing, what is it called? The article, I can't now, I went to a blank. I am on the newsletter. They follow the schools and their progress on the public schools. And one of the challenges with the kids going on Zoom is the lack of technology support. So yes, kids were provided, the equipment to do, school remotely, but they couldn't get it to work. And so when I see, technical support for patrons, it's the right thing to do. I just, we could become the city help desk. And so that's something, it can get unruly. I just don't know, not that it's not the right thing to do. It kind of scares me a bit. I just want to say that.
That's good. I don't think we should adopt that as our new tagline, Boston Public Library, the city's help desk. But I think it does go to our core mission in terms of we are there to make a positive impact on people's lives. And if some of that is about technical assistance, then yes, I think our focus traditionally has more been on training and on helping people develop their own skills and abilities so that they can be more self-reliant and self-sufficient. But certainly, our staff will tell stories about, I helped this patron get online, and I realized they live near me, and I stood outside their house and shouted up at their window on the so people are doing this work in very interesting and creative ways. But I take your point that there are some scalability issues that we would need to pay attention to.
Yeah. So, I mean, again, not saying that it's not the right thing to do. It's just, it can be big, right? Because technology is being provided and I just picked schools because that's a big portion of it. And one of the comments was the lack of support to the students, and parents with the technology. If you think about that use case, they can, the library can be the default to provide that support. So you may have, here's what scares me is that all of a sudden it opened the floodgates, that we have a lot of demand and we don't have enough to supply that, to supply that demand. And then that the community gets frustrated with our services. That's the part that scares me. So I just wanted to call that out.
I would rather have that problem than not enough people discovering that we have this ability and capability. So of the two problems, I'd rather have that one.
All right, good. All right, any other questions?
No, I'll just reiterate, I think this is a great approach for the plan. in the past, it's been very much a technology-based plan and not integrated in this way. So I really appreciate the work, and I think it has a lot of potential for us to continue to develop and innovate.
Yeah, this is great.
Thank you.
I say
I
this
guess
is really
I just
good.
have one question is, you know, if we having equipment and, you know, they're using our services stuff, we have all the privacy so people can, because you go to a library, you take out a book, you know, like what type of guidelines protect people's privacy and confidentiality and just their kind of individual liberties to review and look at the things they want to look at? Is there kind of a standard policy that goes with all of this work?
So we have a open-ended service plan with our hotspot provider to allow people to go where they need to, and also don't record the history of where they've gone with our hotspots. With our Chromebooks that we're going to begin lending, we can configure them to be managed centrally, and part of those settings are include whether or not we keep the history of sites they visit, or even who has logged into the computer. So
Okay.
we do have a privacy forward mentality at the library in general, and have factored that into configuring those settings.
Great, thank you.
Yep.
Sounds great, everything. And it's terrific that we can do this. It really is. So thank you.
Yeah, no problem.
You're muted, Evelyn.
Now it's my turn. All right, so we need to take a vote to recommend to the full board. So can I please get a motion?
Moved.
Second.
Second.
Roll call?
Evelyn,
Yes.
Samawa,
Yes.
John,
Yes.
and David Leonard.
If my microphone is now working, then yes.
Yes, it is. Thank you. Motion is passed for recommendation.
All right, any new business? No? Okay. Public comment?
I believe we only have one public comment signed up at this time. It's David Vieira.
All right.
Jay just has to open his mic. Just give him a minute.
Sorry, I'm finding him. He was here earlier. Where'd he go? There we go.
Yes, good morning, everyone.
Good morning, David.
Thank you all for being here today. Is Kurt still on the line?
Yes.
And
Okay, so I am a Wi-Fi hotspot borrower. I am returning my hotspot today because it's due and I don't want to pay a fine. But thank you so much for the service. I will make a couple of points. I live directly across the street from the Hyde Park branch, and I know that during the COVID period, you've increased the range of the signal. I still can't pick it up very well, and it drops off fairly regularly after a few minutes. So I just wanted to direct you to that. Also on the Wi-Fi borrowing, a few weeks ago, I referred a friend to the library to pick up a hotspot, and the little instruction sheet was not inside the box, and he actually called me instead of the help desk, and I walked him through the process to turn it on. So it would be very beneficial if those Wi-Fi hotspots are checked before they go out the door to make sure that the instruction book is in the box. Again, thank you for the service, and any expansion of service to the broader community, I'm sure, would be welcome and appreciated. Thank you very much.
thank you. Do you mind if I just respond to one item there, David?
Sure.
I'm glad that you're able to use the service and had a good experience. I'll follow up on reminding staff to make sure that the inserts are there and they have access to them. As for the point about being near the Hyde Park branch and whether or not you could pick up the service, Part of the requirements around accepting E-rate funding include that we provide service within our physical locations. And so when we looked at expanding the Wi-Fi externally, we are actually not permitted by the program to expand the Wi-Fi to areas outside of our location. So we really focused on where there were seating areas existing that were on our property, where we could provide improved Wi-Fi network. And unfortunately, we're limited otherwise on expanding it into focusing on people's homes rather than on our properties.
Can I bounce back on that?
Sure.
So a few years ago, I worked for a company that was at 1 Boston Place, which was at the time right next to the then still open Christine business branch. And when the Christine branch closed, someone in the company was complaining that they could no longer pick up the BPL Wi-Fi on the 15th floor of the building. So somehow we've moved backwards on that because they were surfing off the BPL service, and this particular company, which will be left unnamed, is one of the bigger companies in the country and could certainly have afforded setting up their own Wi-Fi system. So that's just an anecdotal bounce back on that.
Thank you. All right. We don't have any more public comment, Pamela?
No, that was the only one.
All right. With that, can I get a motion to adjourn?
So
moved.
Yeah, second. And
Good meeting.
excellent meeting, packed of information. Thank you so much, and we'll see each other next week.
Next
Take
Tuesday,
care.
30. Thank you.
Thank you, guys.
Bye-bye.
Have a great week.
Bye-bye, everyone.
Bye-bye.
Bye-bye.
Thank you.